When socially responsible investing funds first started dribbling onto the market, many fund analysts warned that such restrictions could limit index construction and lower longer-term expected returns. Fast forward a few decades, and hundreds of socially responsible investing mutual funds are available to mom-and-pop investors. The abundance of such funds has translated into exposure to nearly every asset class and global market for socially responsible investments. This raises an important question for those who don't want to invest in companies like gun makers, brewers of alcoholic beverages, or environmental polluters. Are expected returns for socially responsible strategies lower compared to a more conventional approach? Our portfolio management and research team applies an efficient frontier analysis. This means any gains are judged relative to how much market risk is being injected into a portfolio. Without such a risk-adjusted review, leading academics including Eugene Fama, Kenneth French, and Harry Markowitz have raised red flags about the dangers of chasing performance based solely on raw returns. Fama and French actually tackled this in their 2005 quintessential research piece, Disagreement, Tastes, and Asset Prices. Along these lines, it's probably worth noting their 2011 posting on the topic on the Fama-French forum. Like all prices, asset prices are determined by supply and demand. If some investors overweight the stocks of socially responsible firms, they push up prices and reduce expected returns. Similarly, they push down the prices and push up the expected returns of the socially irresponsible firms they underweight. Presumably, that is their goal, to reduce the cost of capital of firms they like by reducing the good firms' expected stock returns, and to increase the cost of capital of firms they don't like by increasing the bad firms' expected stock returns. Fama and French go on to add, these changes in expected returns induce other investors to underweight the good firms and to overweight the bad firms. Socially responsible investing has not been around long enough to measure the magnitude of these effects. We can be sure, however, that if socially responsible investors have any real impact, they push down the expected return on the stocks they overweight and increase the expected return on the stocks they underweight. The growing presence of socially responsible investing raises another question. Are these numbers large enough to have the impact on prices and returns? Members of IFA's investment committee are skeptical. Again, tens of trillions of dollars worldwide are now estimated to be invested into this growing marketplace. So as long as a significant amount of investment dollars is engaged in rational market pricing activities, then we can safely assume that both the securities that qualify for SRI strategies and those that do not are fairly priced.